Good afternoon, everyone. Today I'm chatting with my old pal, Todd Bubba Horwitz. In today's interview, we discuss Trump's tariffs, how real of a threat they are, and whether or not they could actually tank the stock market. Bubba also gives us his thoughts on precious metals like gold and silver, and he gives us a few equity names that he's currently long. All right, everybody, enjoy the interview. Bubba, it's good to see you again.
Stephen, great to be back. Always miss you guys. I'm glad I'm back on with you.
So there's so much happening in the world since we last spoke, and it's hard to make sense of this world that doesn't make sense. Yeah, we now see Mr. Trump has been elected for a second term, and he's basically coming in guns a-blazing. And I don't care what side of the political fence you sit on. There's going to be some stuff he's doing that you have to like, and there's going to be some stuff he's doing that you're not going to like. But for us, I'm sitting here in Canada right now, and we're talking about these tariffs and trying to wrap our heads around what that means economically and that's going to mean for the markets. From my viewpoint, that hasn't even been priced in. I'm curious, what's your take on the tariffs? Do you think that we could see a massive market crash from this? Do you think it's going to be hyperinflationary? What do you think is going to happen here?
I think that tariffs are a non-event as we look at them today, especially for Canada and Mexico. I think that all Trump is doing with Canada and Mexico is trying to put them in a position to do better business with the United States and let the United States take control once again. You know, since his last presidency and through the Biden administration, it was basically how much money can the United States give away and how much can they hammer the taxpayer. And I think that he's using his muscle and flexing. I don't think the tariffs are going to have a big problem. I mean, we had tariffs when he was in office last time, and the markets flourished. I think there's a bigger problem in the banking system. I think that's really, if you're worried about a collapse, which I am, I believe that will come out of the banking system very similar to what we saw in 2008, because I do believe the banks are dramatically over leveraged. And as you've noticed, we've had a rate cut. We've had 3 rate cuts and a total of 100 basis points. But if you go back in time, Steve, you look at September 18th, the 10-year notes were 3.5%. Okay. Since then, the Federal Reserve has cut 100 basis points of their lending rate. Now, remember, everybody, the Fed funds, the rate that you're looking at or getting excited about, has nothing to do with you. It is the money that the banks borrow from the Federal Reserve. It's the rate that they're paying. They then pass on and lend money to you. Okay. And they work on a spread. So what's happened is not only were they making money on before the cut, now they've made an extra 220 basis points because the 10-year notes are now 4.7%. So the 10 years have gone up, which is counterintuitive to interest rates going down. It is a problem, but I think it's a problem because I believe the banks are so dramatically over leveraged. You're trying to help them out ahead of time, and I don't think they can. I think that you're going to see that we're going to have another banking crisis and probably another banking collapse.
There's a lot of thoughts there that go through my head when we talk about that. First off, I'm surprised that this didn't happen over the last year. I know that we saw some of that when we're talking about, say, Silicon Valley Bank, where, you know, banks are generally in the business of borrowing short and lending long, which makes the idea of rates being hiked really quickly sound like it should be very problematic for them. And we never really saw that come into play here in Canada. I don't think Canadians realize this. And I know you don't spend a lot of time thinking about Canada, but, or I assume you don't, but our top 4 largest companies by enterprise value in Canada are banks. And then I go to New York, or I go to Philadelphia, or I go to St. Petersburg, Florida, and I see TD Banks all over the place. And the Boston Celtics play in the TD Bank Arena. They play in the Toronto Dominion Bank Arena. And I can't help but think that we are in that part of the credit cycle where banks got too big. And I think that what you guys have going on in the US is nothing compared to what we're experiencing here.
I would agree with that. And I think one of the big problems is the fractional banking laws, which allow in the States, which allow the banks to lend out 10 times what they're supposed to have in their vault, so to speak. Right? If we go back to the old gold standard, if you had $1,000 in gold, you could lend out $10,000. But now, with the Federal Reserve, the way that it acts, the Federal Reserve is a cartel. It's more like a criminal organization. Okay. And if we know who started it, you'll know that, Paul Warburg and the Rothschild family, and of course, JP Morgan and the Rockefellers, they don't have the best interest of the consumer at heart either. So I think what you see here is that the banks have been allowed to print new money. And during COVID, they lifted the 10-to-1 restriction and allowed them to go larger. Well, the real problem is when I'm a bank and I can borrow, let's say $1 million from the Federal Reserve, you and I would look at that. That's a liability. I owe that $1 million, right? Well, with an accounting trick, they can turn that $1 million liability into a $1 million asset and then lend out $10 million. Okay. So they're creating their own credit problem by doing these things and by being allowed to do these things. And to me, this is exactly what brought the crisis in '08, was allowing the banks to get too much leverage. And that's what I think we're seeing today. We saw it just a small case in Silicon Valley. We're seeing it in other smaller regional banks that are running up against us now. And I think it's only a matter of time before the big banks come. And I think you can look for this statement, okay, for either Powell or whoever is going to be the Fed chair at the time, saying the banks are safe and sound. When they come out and tell you that, you better duck, because this has been the statement that went back to 1929 from Lamont, and it went back to Paulson in '08. When they tell you everything is good, you know there's a problem. But I think we're seeing that problem right now. And of course, inflation is not coming down, which creates another bigger problem. And I can tell you this, in Las Vegas, is where I live now, mortgage rates are 8%. Okay. Now, to me, 8% is reasonable. I would not pay it myself, but it is reasonable. But again, people are used to being in the mortgage business at 3.5% to 4%, which is why the housing market's slowing down. And I think that will be the same criteria we watch. Is I think the housing market will start to melt down. And that will cause a great deal of heartburn, because remember, there's a lot of debt that's resetting in the next 60 days. Okay. And when that happens, where's all the money going to come from? I think that'll be the big problem.
So I take it you're probably short the banks.
No, I'm actually right at this moment, I'm long. Okay. Again, and I think everybody should take note of this. Just because I have an opinion doesn't mean it's going to happen tomorrow. And the markets will give you plenty of time to get in and get short or get rid of positions you don't want to have on. Because more important than any sole bit of news or whatever, the charts will start to show you that there is some weakness. And right now, the charts are not showing you any weakness. They're showing you consolidation, which has been as annoying as you could possibly see if you're a trader like I am, because there's really nothing to do. Okay. We're just churning up near the highs still, but they will break, and they may break out first. I mean, look what happened to gold. Gold suffered and sat in consolidation around 25 to 2,700 forever. Now, suddenly it's almost 3,000.
I was chatting with a friend the other day. I don't even remember who it was, but I remember we were just having a phone call and talking about how the market dynamics have changed so much in recent years, how we're now in this environment where it's like we got a few ETFs and they control everything. And it's fascinating too, because I know people who have started ETFs, and to me, it's an insanely challenging business model. I don't know if you saw Meet Kevin, a famous YouTuber from California, who's got a really, really big following. He tried to throw his hat into the ETF game, and he closed up shop last week because he could only get AUM up to 35 million. And it's you basically got to get to 100 million AUM to actually be profitable as an ETF. And which makes it such a challenging space to just even enter. And 35 million, to his credit, like, that's still pretty good as far as I'm concerned. But what I wonder about, though, is this idea of how ETFs sort of took over, and we've gotten away from stock picking. The idea of going out and finding good stocks that are, mid caps or small caps. Of course, I'm small cap Steve, so I like the idea of stock picking. You think that the pendulum swings both ways, and we've kind of swung so far to the ETF side that at some point we're going to see that kind of break out and we'll move back to stock picking? Or do you think that ETFs are this is just technology making things cheaper, and it's just going to be the new paradigm, and we just got to get used to it?
I think you're right. I think we will see a swing back, but the ETFs, the game has changed a lot since I first became a trader, and that was in 1980. If you heard the term triple witching expiration, right? We used to have triple witching expiration, and that was when big banks and big firms were creating their own ETFs by buying and selling baskets of stocks and then using options against them. Okay. Well, that has changed. We no longer have. They have their own ETFs. They have the representation of the S&P. They have the representation of the NASDAQ. And of course, this also has played a lot of havoc in the mutual fund business as well. Because again, why would I not want to buy, if I want representation of the S&P, why wouldn't I just buy the spiders? They're open end. I don't have to worry about when to sell it. I don't have to worry about my fill. It's instantaneously. But I do think we're starting to see some more new stocks come into play. And I think it'll take quite a while. And I do believe that it's going to take a bear market to change what's going on right now. We haven't had a bear market for quite a while. I think we're due a bear market. I think a lot of the fundamentals are in place to have a bear market. And I think once that happens, I think we'll get back more into reality. But yes, technology has changed a lot of the game. We're never going to get back to what we had before when I started, for example. We're not going to go back to what we had in 2000 during the internet bubble. Okay. But we could get more, and we could get more participants in the market, because what we're lacking now is a lot of participation. And I blame that more on the economy, and I blame that more on the inflation, because if you live in New York, you cannot live in Manhattan unless you're making $300,000 a year. Okay. If you live in California, you're considered homeless if you're not making more than $200,000 a year. And again, the numbers have been inflated so much that it has changed a lot of the dynamics. I think that we're going to see somewhat of a return, not a back to what we all want, or what I want, back a trading floor, but I think we're going to see back to some more of the stock picking, some back more to some of the small caps that you like, because of course the small cap index, the Russell's been nothing but not taking a beating, but it hasn't really participated in the rally either.
So I hate to put you on the spot here and bring back Donald Trump into the conversation, but you mentioned how you think that we might be heading to a bear market. And I got to think about Donald and everything he's talking about. And let's just say that maybe he is serious about these tariffs. You think that he would actually be okay with the stock market tanking? Do you think that if Donald saw the stock market decline 15-20%, we'll say the S&P or the Dow, you think that he'd be okay with that? Or do you think that he would instantly be trying to figure out any possible way to inject liquidity into the system?
Well, knowing Donald Trump, and I'm a fan, just to be clear, okay, I think he's doing the right things, but I think he'd try to do something. Again, one of the problems we have with presidents in full, they always want interest rates lower, and I think he would try to interfere in some way. But I think he also recognizes that the damage that has been done since he last was in office and the amount of inflation that we have seen, I think everybody knows, who realizes it, there's going to be pain. Again, this debt's going to reset. There's Social Security problems. There are so many issues that the best thing that could probably happen is to have that collapse that you're talking about. That's potential. And I think Trump, from a business standpoint, understands that that might be very well the case, that we need to have a meltdown to wipe out a lot of the crap that is around right now, and get rid of, again, listen, true capitalism is a business fails, a new business comes in and takes its place. And I think he recognizes that. Certainly he's not going to want to have that happen. But the good news for us is that even if it doesn't, first of all, what happens is good for me because it gives me something to trade. Okay. And I'm hedged anyway, so I would actually be accumulating more stock on the way down. But I think what he recognizes is, for the health and the wealth of this country, you need a lot of these fly-by-nighters to be busted out. And he's also only going to be a one-term president. This is not going for re-election, right? Unless they change the election laws, this is it for him, right? And he's going to do everything. I think he's going to do everything he can to make the United States stronger. And part of being stronger sometimes is you have to take it in the chin for a little bit first before you can rebuild new strength. And if we do, then you can recreate industry in this country, and you can, you get rid of China, for example. I mean, China, who the hell wants to do business with China? I don't know why all our drugs come from China. That's never made sense to me. But again, I think if you can rebuild, and we're certainly strong enough to rebuild, I think that he would understand that there has to be some failures. He's had plenty on his own, and look at how strong he's always come back.
So I got to ask you about gold. That's something that we cover quite a bit on our channel. We've been the thick of earnings season, covering all the gold majors and breaking down their earnings for our audience. But I got to say, looking at this recent set of earnings, there's a couple of companies who have done all right, but for the most part, it's been disappointments. And really, those disappointments boil down to the fact that we're just not getting production increases from these companies. They keep mining lower grade mines, and with that comes lower production. Where do you think gold's heading? You think that we're going to see, at this point, I think it's a given, we're going to see $3,000 gold this year, but you think that we could see $4,000 or $5,000 gold in the next couple of years?
Next couple of years, maybe. But I certainly think my target this year was 3,300. Okay. And I think that we have a very real possibility. I do believe that short term here, you should look for a little selling. If I own some, not physical, because I don't ever sell my physical, but if I was trading it and owned some from a trade that was highly profitable, I would consider taking some profits. I think the miners are telling you that gold itself is a little bit overextended. Everybody's playing the central bank trade that they're buying gold and so on and so forth. I think the inflation trade has kept gold higher than it should be. But I think if you look at a chart, you're a guy who looks at a chart, it's a little bit too parabolic right now, and it's been pretty much overbought for quite a while now. And again, I'm talking about from a health standpoint, not because I think it should go lower. I do believe there'll be a pullback. And I think pullbacks bring in new money, and pullbacks make it stronger. If we continue with this race and this pace that we're continuing to go up, I think that's going to make it the sell-off all that much weaker and take away from what we want. Now, remember, also now, Besant, who is Trump's Treasury Secretary, he's a gold bug. He's also a crypto bug. So there's a lot of reasons to believe that they may try to come back to the gold standard a little bit here as well. So I think gold is great. I would certainly be a buyer of it. I wouldn't jump in now. If I had new money today and you said, would you buy gold today? It depends on my time horizon. If it was for the next 10 years, yeah, I'd buy it today. I'm not going to worry about it, right? But if I'm looking for a short-term trade, I'd be a seller of gold first. I think silver's a huge play here. I think silver's got a chance to really cut into that gold-silver ratio right now. And I'm a much bigger fan of buying silver right now versus gold. But I do own gold. Full disclosure, I own physical, and I'm not selling it. When I die, my kids will sell it. Okay, because I do think it's a great asset. And initially, I was concerned before the election that gold might be needed as a currency at some point, because the fiat currency system that we're all involved in, those fiat currencies are not worth the paper that they're printed on.
I actually didn't know this until like 2 days ago. But the owner of the Kansas City Chiefs, his last name's Hunt, and he's connected to the famous Hunt brothers. They're from the same sort of family lineage, and I was just really fascinated by that. Anyways,
He's not as pretty as they were, though. You know that story, right? You know the Hunt story.
Oh yeah, so the silver
The silver squeeze.
Yeah.
That they had a chance to get out, with a lot of money, and they said no. And of course, the exchanges have the right to say liquidation only, which is wouldn't welcome.
It was eerily similar to what happened with Robinhood and GameStop, if I remember correctly.
Yes, exactly, because the exchanges hold the power. Now they offered, just the full story is they offered the Hunt brothers $10 million to walk away, profit, and they said no. And they said, okay, liquidation only. And of course, they walked around with nothing.
So the Hunt brothers, would they famously squeeze silver up to, I think it was $50 an ounce.
That was in March of 2009. They had that was, they go back into the 70s and the Hunt brothers, but they squeezed it very high. And again, there was no trade. They locked liquidity, in the Board of Trade, there was limits, and they locked liquidity every day. So there was no trading. Okay, so you couldn't ease off the pressure. What the markets have learned over time is that there is a limit, but if that limit gets hit, then there's a new limit the next day, and it keeps going until they get off limit. but they tried to squeeze the market. Listen, was it 5 years ago, Steve, that well, who's in those guys who squeezed up GameStop and the other group? They're silver company. They tried to squeeze silver, okay? And everybody comes to me and says, "Oh my God, if I'm sure it's open, it's gonna be crazy." I said, "Do yourself a favor. The minute it opens, start selling it because you cannot squeeze an asset that's that big." And of course, it went down.
So have you publicly came out with some sort of target on where you think silver's
I
headed?
think silver's going to close to 40 this year.
Yeah, I
I
hope
think
so.
it's got about a 20% move coming from here.
And it's funny because we've interviewed a whole bunch of CEOs of silver companies over the last few years, and I remember there was one particular CEO who we talked to who it honestly looked like he was ready to take a toaster bath when silver was $18. Like, all of the pressure on top of him having, a thousand employees and a huge amount of debt on his balance sheet, not knowing if he was ultimately going to have to go into CCAA, which is bankruptcy here in Canada. And but he said at the time, it was like, silver sees $30, we're going to be a money printer. And then silver saw $30 and they put out their financials. And guess what? They weren't a money printer.
They had too much debt they had built up over all that time. Again, I think silver is big, and I think the real sleeper out of all is platinum. Remember, platinum at one time was 50% over gold. Now it's a third of gold.
Well, so what's the fundamental reason that
Well, platinum is an industrial. It is an industrial metal that is still used. I think it's still a precious metal as well. It fits into that ball game, and I think if we see industrial production pick up and a lot of things that happen, you could see some buyers there. I mean, you've seen a pretty nasty move in platinum overall, especially as I kept going under gold and under gold. And again, I think things are cyclical, and I think you'll see another demand and another reason that platinum will be in demand. And I think, again, I'm looking at it. I mean, if I were buying today, I'd buy 20% gold, 50% silver, and 30% platinum, just as a spread out of a portfolio. But again, gold is obviously the best out of the bunch and will continue to perform the best. But silver's got a good chance to cut into that very obnoxious ratio that is trading at gold to silver right now.
are there any equities that you are currently really excited about?
Well, I mean, I like a lot of the main ones, but I've been playing this Rigetti RGTI, which okay, and I've been playing in this this one you'll probably like too, Cooler KULR. It's kind of like Master MSTR. It's a Bitcoin player, and it's a $2 side again. But one of the things one of the sites I really like a lot, and I own a lot, is AG, which is First Majestic Silver. Okay, I mean, I trade that around with my people, and I always carry a core position, but I say, we want to be a buyer at $5, like we were a buyer just recently. And again, but I think it still really needs to break back over 6. And I think get over 6 and hold. I think it's going back to 12 to 15. And I think it's got a chance to go higher if I'm right on silver. But it's like, to me, it's a great, cheap little play to keep people out of trouble from getting too deeply invested in things that they can't get out of.
And something I really like about First Majestic, in full disclosure, they are an advertiser over on our site, The Deep Dive. But the thing that I find so fascinating about First Majestic is that they have such a large shareholder base. They have over 80,000 shareholders, which in mining is unheard of. We also know how amped up silver investors can be. The silver bug is like its own species. And when silver starts to move, you are going to see so much traction on social media in First Majestic because of that shareholder base that they have. And I agree with your thesis. I think silver's heading over $40 this year.
I've owned First Majestic for 7 or 8 years.
Wow.
So, and I love to play it. I mean, to me, it's a great little stock to not only own, and I'll never sell. If my core position goes to zero, it goes to zero. I'm prepared for that. But I've made so much money on trading it and watching it go up to 10, 12, 15, and then come back down again, where I take pieces out. but while always holding a core position. And I like the Bitcoin stocks too. I actually, for those that might be interested, I like BITO a lot, BITO. And I don't like it because it's a stock. I like it because it's related to Bitcoin. I'm a believer in Bitcoin, but I really like it because it pays a 52% dividend.
52% dividend. How are they doing that?
Well, they're telling you it's a high risk play. But again, I look at it this way. If the stock can stay in business for a couple of years, you're going to get all your money out and it's going to be for free. It is a non-qualified dividend for American taxpayers, though, but
Is that an ETF?
it's an ETF, yeah. It's an ETF that correlates directly to the BTC on the exchange.
Just quickly Googling it, it says that there's an annual dividend of $14.61 to a yield of 63.87%. I'll send that screenshot that I have over to our editing staff so that they can put my screenshot up. Todd, thanks so much for hopping on here.
I'm glad to be here. I miss you guys. It's always fun to be on your show.
Well, let's not wait so long next time we have you back on here. And if our audience wants more of your commentary, I know I see you on Fox Business all the time. Where else can they go to get more of your commentary?
They can go to BubbaTrading.com. They can email me direct as well, Bubba@BubbaTrading.com. And if it's okay, I've written 2 books on options.
Okay.
If I'd like to give it away to your audience if they want, if that's okay.
Yeah.
Okay. You just email me at Bubba@BubbaTrading.com or go to BubbaTrading.com and you can get a free ebook now. It is on Amazon, but you can have the ebook for free. It's Bubba's Guide on How to Trade Options.
Bubba, thanks so much for hopping on here.
Thank you.
Let's do this again soon.
I can't. I won't be. My hair will be grayer next time. Last time my hair was brown when I was on.
Thanks for doing this.
Thanks, sir.
All right, everybody. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Also, let me know what you think in the comment section. Thanks, everyone.